going to have to increase debt in some way, or they're going to have to, or they're going to erode any existing working capital, okay? So, break even for me, on what we're establishing, if this client has to make this and they've never come near it, it doesn't matter. These are all the past sins that they have committed. It has nothing to do with us. These are the past sins they committed. They made a lot of decisions not knowing the information, and this is where we land today. If the client also, I'm just going to use a figure of $1 million. Let's say I've gone through the fixed cost capacity. I've looked at where we can actually trim out based on an ROI budget, not a pro forma budget, not a percentage budget, but based on an RO budget. I've figured out that client needs, as an internal infrastructure, to spend $1 million, right? How much gross margin does this client have to make in dollars? Shout it out, how much? How much does this client have to make in gross margin? Anybody know? $1.3 million. Everybody see how I got that? They have to make a gross margin of $1.3 million this year. There's nothing that the client can argue, there's nothing the CPA can argue, there's nothing anybody can argue. That's how much gross margin that client has to make this year. So I've gone through the pricing model and I've determined that that client, based on whatever their model is, whatever their equation is, that client produces an intended 25%. That doesn't mean they've ever performed that way. Their model already said that I'm going to buy it, add margin, sell it. And when I add all those up and I can actually check and balance it on numerous bids they've already put out, that client is supposed to make 25%. If they do not have these 4 specific things in place for each one of their cost centers, the chances of them controlling and actually producing a 25% gross margin are very low. Very first one is a standard. Example, your material based on your pricing model dictated that you have to maintain your at 35 cents. Not because that was your average, not because that was your optimal, not because it was anything that, is because based on your model, the way you buy and sell it and your final selling price, you've written it over and over and over again, and you authored the actual pricing model, it's supposed to be 35 cents. That's the true cost based off that, only your formula, nothing else I'm coming up with in terms of industry standards. That's what you said. So in terms of if the market shifts in terms of pricing of your material or anything else, you're still buying it, adding margin, and dictating what that true cost is supposed to be. In terms of labor, the labor is built off of a bill-to-sold ratio. What's an acceptable amount of your hours being billed by your labor force versus how much you sell to your clients? And it's not, and it is a percentage, but when it comes down to it, you break it down into an hourly basis. Everybody follow that one so far? You buy 40 hours, you sell a certain amount. Those are standards. Measurement, we know very well that accounting has nothing to do with running a company. Somebody may argue that, but it's too historical. The most reconciled picture you can get of how we did in July is probably right about now, maybe another week from now. The game's over. What RTO does is gives the client a dashboard to be able to see where they are in the game. What is the down and distance that they have to travel? What quarter it is? What's the score? How much time's left? How many timeouts I have left? Being able to see to be able to make decisions. Measurement with accounting, historical. Measurement proactively, I can make decisions now that change the outcome of the game. So measurement is the other one, but it's proactive. Operational controls. Our clients have different operational controls. Operational controls.